Hey, I'm Ben from Monogram, and today we're going to do a Monogram valuation of UGI Corp, another dividend aristocrat stock. So let's go ahead and get into it, and be sure to stick around to see what I think of this company. So we've got the company name, of course, is UGI Corp. I already said that, but the ticker price is a very unique UGI. Well, unique isn't quite the word I wanted there. I wanted to have more of like a creative ticker, UGI, because the name is UGI. Okay, I'm going to move on. Current price is $38.52. The sector is utilities, and the industry is utilities regulated. So this is a regulated utilities company, and these are the things from the balance sheet that I find most important. We have total current assets, total current liabilities, long-term debt, total assets, intangible assets, total liabilities, and shares outstanding. And all of these figures will come into play in the valuation. Over here, we have a chart showing the earnings per share diluted over the years in blue and the dividends per share in red over the last 30 years. And you can see that dividends have continued to rise and earnings have gone up. They did take a big hit in about 2018. We saw a drop from went up very high to 406 and then came down to 141 and then had another huge rise. In 2020, it got up to 692 and has come back down since then. But overall, the trend is upward. Looking at the detail of that, you can see, again, in 2018, it spiked to 406 and came back down. 2021, it went to 692 and it has come down from there. But more important is the earnings per share MG, which is a weighted average of the last 5 years of earnings, putting the most weight on the current year and the least weight 5 years ago. And that can help you look at longer term trends with a smoothed out business cycle. And you can see that over the years that has gone up. And even with the spike, the trend was still generally upward. It did spike a little bit and came back down, but that wasn't as drastic as in that on this side. So it kind of lessens the impact of this 2019, the earnings per share really dropping so much. It drops a little bit, but you can see a long-term trend was still present of generally going upwards. Dividends, you can see the dividend amount there. You can see dividend growth. Again, it has grown its dividend for at least 30 years. We'll get the exact number later on. But the dividend yield itself has been between 2 and generally about 5%. Lately, about 2 to 4%. Dividend payout ratio has been lower lately. But then again, in 2019, when that earnings dropped, the payout ratio spiked because they do put a really strong emphasis on keeping that dividend growing. And that is always a good thing to see. And you can even see, even when the earnings dropped, they actually increased their dividends more those years than they had in the years prior to that. So that is interesting to see. Stage 1 of the analysis is to determine if the company is suitable for the defensive investor or the enterprising investor. And remember, the defensive investor is one who is not willing to do a lot of research into a given company. And so they have very stringent requirements for what they will look at to invest. And we have market cap has to be over $2 billion. Here it is $8 billion and some change. And so it passes that. Current ratio has to be greater than 2. Here it is only 1.02, so it fails. Typically, utility companies have low dividend or low current ratios. So there we go. And earnings per share has to be positive for 10 straight years. It passes that. Dividend for over 10 years, obviously it passes that. Increase in earnings per share growth here. At the beginning, average over the past 10 years, it was 1.71, and now it's 4.81. So it has had very good earnings per share growth. Passes that. And PEMG, that is the price to that weighted average of earnings, that comes to 9.19. That is less than the requirement of 20, so we pass. Price to book ratio, we take the price and compare it to the book value. We get a price to book ratio of 1.61, which is less than the requirement of 2.5, so we pass that as well. So we get 6 points out of 7, and we pass for the defensive investor. And by default, we are then suitable for the enterprising investor, which is good because the company would not pass the test for the enterprising investor on its own. The current ratio is too low, and the debt to net current assets ratio is too high. So we are suitable for the enterprising investor, though, because we are also suitable for the defensive investor. Now, if you're enjoying this, be sure to take a moment to like the video, subscribe to my channel, and download the free valuation calculator found in the comments and description below. Stage 2 is a determination of the intrinsic value. And remember, the intrinsic value is what the company is worth. The price is what the market is willing to pay at any given time. And so you want to look at the value before you look at the price. And the value, we take Benjamin Graham's value formula from the book The Intelligent Investor, and we get value equals earnings per share modern Graham times 8.5 or plus 2 times the growth rate. That is the formula. I've updated it with the weighted average of earnings to get the modern Graham value formula. So we have 2 variables to calculate, earnings per share and growth. And earnings per share, again, we look at the last 5 years of earnings, putting the most weight on the current year and the least on 5 years ago for an earnings per share modern Graham of 4.19. Then we take that and the earnings rate 5 years ago of 2.43 to calculate the total growth between the two of 72.6%. Divide that by 5, you get an average annual growth of 14.5%. And this safety margin, that it's very important at this point to have a safety margin because the growth is such a key factor in this formula. If you overestimate, it can really swing that value way up high. And so we put that safety margin here and we cap the growth at 10.89%. And that may actually still be too high. We'll see in a moment some other figures. But if you take that, the earnings per share for 19 and the growth estimate of 10.89, you get a value of 126.94. And with this very handy chart over here, you can see the current price is only 38.52, but the value is 126.94. That's much more than 38.92. So the company is currently undervalued. Looking at net current asset value, that would be the floor to your value. It doesn't play in here because that is negative. Then if you look at the formula based on a 3% growth, you get a value of 60.78. And if you look at it at a 0% growth, you get a value of 35.63. If you put price in for value and solve for the growth rate, you get the market implied growth rate of 0.34%. So now you could say the market is implying growth of only, 1/3% in perpetuity. But this formula came out as the growth estimate of 10.89%. That seems awfully high. So maybe this is a time to rely on these other ways of looking at it. One would be with the value based on 3% growth. If you think the company will grow at 3% in perpetuity, that would be the value. If you think it will grow at 0, that's the value. And most importantly, if you just take a look at the market implied growth rate and you think that the company will grow greater than that in perpetuity, if you think that, say, it will grow at the rate of inflation, then that would be an indication that this is an undervalued company. If you think it will grow less than 0.34%, maybe you believe that it will shrink over time, then it would be an indication that it is overvalued. Coming down here to the modern Graham grade, this takes into account other factors so that you can have a letter grade on a company and compare it to other companies in other industries more easily. So we have 2 points for investor suitability. It is suitable for the defensive investor. We get 1 point for being undervalued. We get 1 point for trading below its Graham number. We get 1 point for a long-term dividend growth, 0.5 point for a dividend yield over 2%, half a point for trading below its PEMG or its average, its industry average PEMG, and 0 points for trading below net current asset value. Total points, we get 6 points, and that is greater than what we need for the A+ grade. So it is an A+ in the modern Graham grade system. Stage 3 is further research. If you've gotten to this point and you've determined that it is suitable for your individual investor type, and it is suitable, and you believe that it is undervalued, then it's time for you to look at it as consideration for your individual portfolio, taking into consideration things like diversification or your investment goals and things like that. You have to do this. I can't tell you whether or not it's a good buy for you, but further research could help with that. And again, net current asset value, that would be a floor to your value. Here it's negative, so it doesn't really apply. Graham number formula, that is a formula derived from the defensive investor requirements to put a number on them as a quick way of looking to see if it would be undervalued based on that. The Graham number is 4117 here, which is higher than the price, so it is an indicator that it may be undervalued. PEMG, again, is 9.19. Current ratio is only 1.02. Price to book is 1.6. Dividend yield is currently 3.74%. And it has 38 consecutive years of dividend growth. Stage 4 of the analysis is to look at the chart. So if you've determined that this is a good fit for you, now would be the time to look at just a little bit of technical analysis. You don't want to ever determine the value of a company based on technical analysis, but it can be useful in trying to maximize your profits or your gains by looking at which way the market is swinging when you are trying to find your entry point. And here we're looking at this. You can see that it has come down in recent days, and it recently closed below its long-term moving average, which it did back in December as well, and it ended up just being flat before going back up again. But that could be an indicator. You can see in the past when it has done that, it has been an indicator that it could be on its way down, especially when those other moving averages cross over that long-term one as well, which hasn't happened here yet, but it would be something to watch. Coming down to the relative strength index, you can see the momentum in the company. It was overbought in November, and then it came back down a bit. And then it has come back up, but it didn't quite cross over into the overbought territory this time. But that momentum is trending towards the downside, and you can see the red and the blue lines on this are the moving averages of the relative strength index, and those got pretty high too in November, and now they're coming back down. They weren't quite as high, so it may not be as striking as it was there if it were to come back up long term. But it also is not clearly oversold like it was back in October, where we saw that short-term relative strength index drop way down, and then the moving average was getting really low and even crossed into the oversold range itself. And so like this was a great time to buy. You can see that reflected with the candle here, the bullish engulfing candle here really confirmed that that might have been a good time to buy there. Those are things to look at. Looking at the weekly view, you can see, again, we might be in an okay spot now, but it came way down recently in this past week. It has dropped quite a bit, and now it is below all of those moving averages, and that might indicate that it's going to come down a little bit further. So that is something to watch. Be sure to check out the video on the screen now. It will be one that you will enjoy and find useful. Thanks for watching, and I will catch you next time. Take care.